Okay, in this first box, I want you to go over what I believe are the big formulas, big picture macro stuff. So you're going to have the expenditure model for GDP. It's the one you've seen all year. So it's AD, which is aggregate demand. Sorry for the small space. I realized I need to adjust that. So aggregate demand, remember, if we add up consumption, investment, government spending, and net exports, which is X minus M, that would create everything we need to solve for how much GDP we can have, or if aggregate demand is increasing, decreasing for one of these parts. Right? On the opposite side is national income, or the income derivation of GDP, is when you simply add up wages, rent, interest, and profit. And those are all the different forms of income that people can have. Okay? Short-run aggregate supply is SRAS, and that's going to be composed of things that are productivity inputs, like input cost. Productivity is how much product you get out of your labor with a set amount of materials and time. And remember, it's if we can get more productivity with the same amount of materials, with the same amount of materials and less time, or vice versa, then productivity would go up. That would be economic growth. Or when we shift supply to the right or left. These are input costs, things that you put into your product as far as cost of production goes. The second I is inflationary expectations. Remember, if we increase our inflationary expectations, we think things will be more expensive in the future, and businesses would either increase supply or decrease it based on these expectations going up or down of future costs. The last one is government regs, or government regulations. And these are on the business side once again. So if corporate taxes go up, payroll taxes, unemployment expenses, subsidies. Remember, subsidy is a government payment to an industry. So if you're a business and you get a subsidy, your short-run supply would increase because you're getting money you don't have to pay back from the government. And of course, regulations. If you own a factory and things are, say you have to add more scrubbers to your factory's smokestacks, then that would cost you money and your supply would decrease. Okay, so once you know about once you have AD, or aggregate demand, fiscal policy can be used to try and control or help with a recession or inflation. So if we have expansionary fiscal policy when there's a recession, we can lower taxes, which would make consumption increase. Therefore, aggregate demand would go up, and we'd get the economy going again. We can have government spending, which we can raise government spending. That would pump money into the economy, because those people who get paid at their job by the government, or government contract purchasing, like helicopters, tanks, things like that, or coffee, or whatever it is. If government spending goes up, and aggregate demand would increase and shift to the right. Okay? If we have an economy that is overheating, we need something red, we need contractionary, we need to have high prices. So we need to raise taxes, which would slow consumption and decrease aggregate demand. We can lower government spending, that would also decrease aggregate demand. Okay? Those are our expansionary, like green. Remember, green, make it go when we have recession, and then red, make it slow when we have inflation. Now, remember, in the short run, the prices and wages are sticky. Think about menu costs and the fact that workers don't want to take a pay cut, and bosses or companies are also hesitant to give pay raises. So in the short run, prices and wages are sticky. Now, if we're into a recession, prices and wages are flexible. So in the end, if you don't have a job, you might get a job for lower paying wages. And so remember, if we do nothing, then in the long run, short run supply would increase to the right in the face of a recession, because workers will return to work for different wages. And of course, we have capital stock. Anytime we need to talk about economic growth, if we increase our human capital, that's our skills, our abilities, simply more workers. Real capital is the tools and machines we use to make consumer goods. And remember, anything that you use to make money, that is going to be a capital good. And we purchase real capital with financial capital. That's loans, bonds, anything like that. So all those compose our capital stock. And don't forget that net investment means if we replace and add to our capital stock, we have positive net investment, which leads to economic growth.